Okay, welcome back to the program. Let's review what GT Bank reported about a 10-page document released in January this year. Says this was his outlook on the 2017 Nigeria's economy. Let's take that for you very quickly. This was what GT Bank pushed out in that report. The bank, according to its analysts, calls that the report the year of economic recovery and growth. That was even before the budget 2017 was released. GT Bank says one of the top 3 banks in Nigeria says it sees 2017 as a year of economic recovery and growth. Why? What are the scenarios in this report? The first scenario, according to GT Bank, was that oil prices will remain around $57 a barrel, and the successful resolution of militancy in the Niger Delta will be Nigeria's best case scenario. Now, the second scenario in that report was that oil prices will crash below $40 a barrel, and the attacks on the oil facilities will continue following the inability of the Buhari's administration to resolve those issues with the militants. That's the worst case scenario. Now, we've seen a bit of a mix of these two scenarios. What's the outlook on scenario number 1? GT Bank says it expects to see improvement in Nigeria's foreign exchange earnings with attendant impact on FX supply, business activities, and economic well-being. Well, that looks it has happened. Well, economic well-being of the people, I can't sign off on that. I don't want to get a lot of flax whether there's been an improvement in Nigeria's economic well-being of Nigerians in the last 6 months. I'm not too sure I can give a pass mark on that. But of course, as far as the impact on foreign exchange supply, yes, we've seen that. We've seen business activities, but the well-being, I may have to ask Omotola Abimbola here in the studio about his well-being since January, if things had improved for him. What's the outlook on scenario number 2 by GT Bank? That a further deterioration in oil prices and in the Niger Delta militancy could lead to worsening of FX environment, depression of business activities, and protracted economic contraction. That scenario 2 seems not to have taken place since the first 7 months of this year. So we're looking at scenario number 1. And that means, takes us to point 3, where the bank says that we expect full implementation of the terms of the flexible exchange rate policy. It looks like the central bank has listened to that, which will aid effective price discovery and eliminate multiplicity of exchange rates. Then the combination of policies with improvement in FX earnings will ultimately lead to slower inflation and narrowing of gap between official and parallel market rates. We also signed off on that. That has also happened in 7 months. Number 2, we expect improvement in FX supply and stability, coupled with the base effects, will cause further moderation in inflation. We've seen that also happen, so we tick off number 2. Let's go to number 3. GT Bank says it believes that the present inflationary pressures is not entirely a monetary phenomenon, and the use of monetary policy tools alone might be ineffective. I think we all seem to agree on that point as well. What are the final 2 points? Yes. GT Bank says it expects the Buhari's administration to commence implementation of fiscal policies that will not only augment monetary policies already in place, but also spur productivity and encourage local production. That is still on the street. The jury is out on that. And finally today, this is what the GT Bank says. They believe that it is not unlikely, conclusively, that central bank may bow to pressure to ease interest rate by half year. Now we're down to half year, aren't we? Omotola Abimbola is one of the investment analysts at AfroInvest Securities and is live here in the studios with us. Good morning and thanks for coming through. Good morning. I'm sure you listened through that, what GT Bank considered as its own outlook on the economy for 2017. You agree with one of those scenarios, don't you?
Yeah, I do agree with them on some of the scenarios. For instance, since the beginning of the year, we have seen improvements in Nigeria's macroeconomic picture generally. We have seen increase in oil production, which has enabled the CBN to be much more active in the foreign exchange market. So that has narrowed the parallel markets premium for exchange rates from over 150 naira to the dollar before to less than 70 naira to the dollar now. So that's a positive. We've also seen growth fortune also improving. Q1 GDP growth, contracted by 0.5%, but that was even much more better than expected. And for Q2 2017, at Afri Invest, we're expecting a rebound in growth, by up to 0.7%, for the second quarter of the year. And that will be driven by the low base impacts of the oil sector GDP, as well as the sustained improvements in the non-oil sector as well, which is being driven by the improvements in FX liquidity in the foreign exchange markets. So, generally speaking, for the macroeconomic picture, we have reached an inflection point already. But for monetary policy, we do not expect to see any sort of policy easing in the short term. The MPC will be meeting between today and tomorrow, and our expectation is that the committee members will vote to maintain status quo on all policy rates. And that seems to be the general opinion of the markets as well. If you look at consensus forecast, polled by Bloomberg.
Since January, when we rolled out, we took a bit of a reminder of a review of some of the highlights of the key considerations for the MPC back in January. Let's look at the markets, and let's keep you to this market side of this conversation. We're going to talk about bigger macroeconomic issues later with Johnson Chukwu from Akari Asset Management. But in terms of the stock market, so let's take a bit of this asset portfolios and classes one after the other. The stock market seems to have been on a roller coaster since January. That it looks like at every MPC communique, the governor of the central bank seems very happy. Governor Nevele seems too happy to say, look, the stock market is working. Look at the numbers, and it details the index, the market cap, and what have you. And it looks like a very good part of a big paragraph in every communique since January 24th.
Correct. That's also surprising. Like I mentioned before, in between March and April, we saw it turn around the macroeconomic fortune, and that has had an impact on the equity markets as well. First, Q1 2017 earnings were quite solid across a number of sectors, from banking to consumer goods and industrial goods. So that sort of catalyzed activities in the equities markets. And then in April, we saw the central bank moving from its earlier pegs, exchange rate regime to a much more flexible one, with the introduction of the high and yield window, investors and exporters window, which has been a boon for the equities markets. So foreign investors are now much more active in the domestic markets. For instance, when we looked at foreign portfolio investors transaction in the equities markets in May, we saw that it's increased, fourfold, from about 21 billion naira or thereabouts in April to over 70 billion naira in May. So that shows that foreign investors now have much more confidence in our domestic markets and the economy in general. And we expect this performance to continue in the short term, although we do not expect the sort of 30% return, to occur again the second half of the year. But we're expecting a single-digit return between 8 to 10% return, for the benchmark index in H2.